We've all seen headlines like small caps rally 5%, mid caps outperform, or large caps move more steadily. These terms show up almost every day in market news. But what do they really mean? And more importantly, why do small caps often move faster while large caps tend to move more steadily? In short, it usually comes down to how easily the stock trades, how many shares are actually available to trade, how much information is out there, and how money flows in and out of that segment. Stock prices move for many reasons: earnings, news, sentiment, etc. But one helpful lens to understand why different stocks behave differently is market cap or market capitalization, which is a rough way to group companies by size. In this video, we'll break down what small cap, mid cap, and large cap stocks actually are, how mutual funds use SEBI's framework along with AMFI's market cap list, and most importantly, why these categories often behave differently in the market. So small cap, mid cap, and large cap is pretty much a label based on market capitalization. They don't guarantee returns or stability, but they can help set better expectations for risk and volatility. So let's start with the basics. What exactly is this market cap number? To understand small cap, mid cap, and large cap stocks, we first need to understand how a company's size is measured in the stock market. Outside the market, we might judge a company by employees, offices, or revenue. But in the stock market, size is measured by market capitalization or market cap. So imagine you start a small bakery with a few friends. To track ownership, you split the business into 100 equal parts. Each part is a share. If each share is worth rupees 10, your bakery's total value is rupees 10 times 100, which is rupees 1000. That's market cap. Share price multiplied by total shares outstanding. Now, two things can change market cap. The share price changes or the number of shares changes. Now, let's say your bakery becomes popular. Maybe more customers are coming in or investors believe your future expansion looks promising. So the market is now willing to pay rupees 20 per share instead of rupees 10. Sometimes the business hasn't changed much overnight. Sometimes new information genuinely changes the outlook. Either way, the price reflects what buyers and sellers believe right now. So your market cap becomes rupees 20 times 100, which is rupees 2000. So here's one important clarification. This doesn't mean rupees 2000 went into the bakery today. It's simply the market's current price tag for the equity at that moment, not necessarily the business's intrinsic value. And that's the basic idea behind how listed companies are valued too. Now that we understand what market cap is, let's see how this turns into those small, mid, and large cap groups you hear about. Now let's take the bakery story a little further. In the early days, it's one small shop. Fewer customers know you. The business is still proving itself, and that's often what people associate with small caps. Companies where uncertainty can be higher. A few years later, you expand. You open a few outlets, the brand is getting noticed, and the business is more settled than before. That's often how people think of mid-caps, more established but still with room to grow. Fast forward a decade. Your bakery chain is now a known name. You're in multiple cities and profits are more consistent. That's often what people associate with large caps, bigger, more widely owned companies. But here's an important point. Market cap doesn't perfectly equal stage. A company can be small and mature or large and still fast growing. So think of these groups mainly as size-based categories. And size often goes with things like liquidity, coverage, and consistency, which is one reason price moves can differ. And this all makes sense. But you might be wondering, who actually decides which companies go into which group? That's where India's regulatory framework comes in. So until 2017, there wasn't one consistent standard for large, mid, and small cap groups in India. So in October 2017, SEBI introduced a uniform framework for mutual fund scheme categories. To apply this consistently, mutual funds use AMFI's market cap list, which ranks companies by market cap and is updated periodically so companies can move between groups over time. Broadly, the groups are large caps, top 100 companies by market cap rank, mid caps, companies ranked 101 to 250, and small caps, companies ranked 251 and beyond. This helps fund categories stay consistent when they build portfolios. And because these rankings can change as companies grow or get smaller, there's a simple way you can check where any stock stands today. You can check whether a stock is in large, medium, or small cap on Kite by simply tapping on the stock and then on fundamentals. Alright, so now we know what these categories are and how they're defined. But here's the really interesting part. Why do they actually behave so differently in the market? So back to the real question. Why do small caps often rise and fall faster? A lot of it comes down to liquidity and depth. Essentially, how many buy and sell orders are waiting in the market. First, let's look at liquidity and order book depth. Large cap stocks usually have more buyers and sellers every day. So even big trades often get absorbed without the price moving too much. Small caps can often have fewer active participants and thinner order books. So even a smaller buy or sell can move the price more sharply. For example, if only a few sell orders are available at nearby prices, a market buy can jump levels quickly. Second, free float and ownership. Some small caps have a lower free float, meaning fewer shares are actually available to trade. Lower free float can mean less depth, so prices can move more on smaller trades. Third, information and coverage. Large caps are tracked closely by analysts, media, and institutions, so news about them often gets priced in relatively quickly. Small caps may have lower coverage, so when a big update comes, good or bad, prices can adjust in steps, not smoothly. Fourth, business predictability. Large companies often have multiple revenue sources and more diversified businesses. Smaller companies may depend heavily on fewer products, fewer clients, or a single expansion plan. So one event, like a big order win, a regulation change, or a bad quarter, can shift expectations more. Fifth, flows. When money moves into or out of a segment through mutual funds, institutions, or broader risk-on, risk-off sentiment, large caps can absorb it more easily. In small caps, the same flow can create a bigger price impact because the market is thinner, especially when sentiment turns. That's one reason small caps often show bigger upswings in strong markets and deeper cuts when conditions turn volatile. And one more important point. High volatility does not guarantee higher returns. It simply means outcomes can be wider both up and down. So risk control and time horizon matter. Now, if picking individual stocks across these different segments sounds like a lot of work, or if you simply want professional management across these categories, that's exactly where mutual funds come in. They offer defined categories with clear rules. For example, in simple terms, large cap funds, at least 80% in the top 100. Mid cap and small cap funds, at least 65 in their group. So when you choose a category fund, you're not just choosing stocks. You're choosing the kind of volatility and risk that often come with the segment. And if you want one fund that can mix across large, mid, and small caps, flexi-cap funds can move across segments depending on where the fund manager sees value. Multi-cap funds have defined minimum allocations across large, mid, and small caps. Remember, these rules can evolve over time, so it's always worth checking the latest scheme documents. If you have any queries, feel free to drop them in the comments and we'll be happy to answer them.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Brokerage will not exceed SEBI prescribed limits.